Hey Kyle, great to be back on. And look, hasn't it been a huge week in the markets with that US inflation number coming in above expectation, and that really adds to the all the negative news we've been getting for several weeks, really even several months, much of this year. And I think it's fair to say that sentiment remains extremely bearish across the US markets and pretty much markets in general. And that's so understandable given the macro backdrop. You look at that and it's just awful. It's hard to see how that's going to repair itself anytime soon. But I think the point that we need to consider is that rarely does the market do what everyone expects it to do at the same time that everybody expects it to happen. And it's really interesting. I've been seeing a chart going around, a comparison chart going around the Twitter sphere over the last few weeks. And what it's doing, it's comparing the S&P 500 from 2007 2008. That was during the GFC, and it's comparing it to now. And when you do that overlay, it looks like it's a really close match. And it can be easy to look at these things and say, well, this is our roadmap for going forward, because it's been such a good match so far. It should now tell us what's going to happen next. But I've been seeing people do these overlay comparisons for decades, and it's really that straightforward, because markets often have these similarities to other periods, and that's largely because movement is partially fueled by emotion, and emotion tends to play out in particular ways. And while this 2008 scenario rerun is, look, it's always a possibility, I think we should assign a lower probability to it. I think there are too many people just at the moment anticipating an imminent meltdown, and I'm just not sure the market's going to simply deliver what people are expecting and deliver it when they're expecting it, i.e. now.
Interesting. Okay, so there we've got that overlay chart. It gives you a little bit of a possible roadmap as to where we go, or at least can sort of frame where we are in the picture right now. But what about the technicals for the S&P 500, especially after the sell-off that we saw early on in the week?
Yeah, really interesting to watch the price action over the last few days. Pull it up on an hourly chart, 4 hourlies, dailies, and just dissect it all and see how it's all looking. So what we had that big sell-off on Tuesday. But what's been interesting is there was no follow-through selling on Wednesday, being last night in the US, and that's very different to what we saw during June, when we had some negative news came out, and the market broke lower and sold off heavily for 4 days in a row. So as things currently stand, the September low remains in place. It wasn't broken by this week's fall. And prices are sitting on a support zone, which you can see that blue horizontal line. That's around 3,900. So I think both of those are near-term positives. Against that, we've got to balance that with the overall technical setup, which we can get on this chart as well. So just going through that, from the top, we've got a 3-point down trend line. Now, when you get 3 points on a trend line, it becomes a pretty significant trend line, and it's one to pay close attention to. So at the moment, this tells us the primary trend is still down. And we look at the moving averages. I've got the 50 and the 100-day moving averages on the chart. They're still pointing lower. The 50-day moving average is still leading the 100-day moving average lower, so that's a negative. And the S&P 500's current price is below both of those moving averages. It's been oscillating above and below over the last couple of weeks, but it is below. So from that standpoint, these are reasons for continued caution. And that's been pretty much the message that we've been talking about over the last several months, or maybe even the last 6 or so months now. It's been quite a while. But against that, I still think there's a case for at least having selective exposure to the market. Because Kyle, like bear markets are all about inflicting pain. They're about causing confusion. And this one is absolutely no different. And with so much negativity going around at the moment, I wonder if the market does something that surprises most people and rallies. So wouldn't necessarily signal the start of a new bull market, but there is a scenario where stocks could attempt to rally over the next few months and still be forming a large topping pattern that continues to play out over into next year. But look, I think let's see how the rest of this week plays out. While support's holding at 3,900, I think we should be open to at least open to what would seem like an unlikely rally. But that said, if the S&P 500 breaks that support at 3,900, gets down to 3,800, then we're probably going to see a retest of that June low before long. So look, it's going to be, again, going to be a very interesting week to see how this plays out.